All right, our next speaker is Bob Pavey. He is a partner with Morgan Thaler Ventures, and he's been a partner since 1971. From 90 to 92, he served as president and then chairman of the National Venture Capital Association. Morgan Thaler Ventures has a dedicated practice in the IT industry broken down into three areas: internet services, enterprise services, and mobile platform services. They can make investments as small as $500,000, but their total investments they expect to be in $5 million to $15 million per company. Bob's major focus is on wireless, semiconductors, materials, devices, and energy. He sits on the board of directors of CLE Design Automotive and other companies, and he's also been involved heavily in many of the firm's most successful investments, such as Apple Computer, Applied Intelligence Systems, Aptus Communications, Atria Software, and others. Bob will share Morgan Thaler's view on IT investing, including what they see as some exciting opportunities coming along. Please join me in welcoming Bob Pavey.
Thank you very much. We've probably got a here for me too. So it's nice being with you all today and with you in the various universities and campuses also. Thanks for having me. And what I'm going to cover, what I've been asked to cover, is the role of venture capital in information technology in your world. And then what we see as new and exciting in IT, i.e. what kinds of things are we excited about financing right now. We just had a couple of questions. I would encourage you to interrupt me with a question if there's something that you'd like to ask. This is a small enough group, it can be, I think, a little bit collaborative. So let's interrupt if you've got some questions as we go through this. So let me start with sort of a little background to put venture capital into perspective. Boy, those lights are bright, aren't they? You faculty members are used to those. I got it shining in my eyes. I came to Cleveland in 1967 out of business school and joined a little venture-funded company in Cleveland out near the airport, a materials company. And that was 1967, 44 years ago. And I fell into venture capital because the CEO of that company sold out. He made himself enough money to start his own. He was an angel at the time. They now talk about super angels, where Dave Morgenthaler was an angel 43 years ago. And I guess his briefcase got a little heavy, and he asked me to join him one day and carry his bag around, and we formed a firm. And then he was no longer an angel. He now had a venture capital firm. And we did that in '71, and we've been at it ever since. Let's see how many things I can hold at one time here. The chart up on the screen now kind of gives you a flavor of venture capital, not going all the way back to '70 when an old guy like Bob Pavey got in it, but from '80 through now, and it's in two halves just because the scale gets crazy otherwise. It's hard for people to realize how small venture capital was 40 years ago. In the 10 years before 1980, the entire venture industry invested about $100 million a year. That's California, Cleveland, Boston, Michigan, the whole country, pretty much the whole world, because there was no other venture capital elsewhere in China and India as there is today. The industry started to grow right about there in 1980. Turns out the National Venture Capital Association was successful in convincing Jimmy Carter that you could help young companies by not reducing the taxation on dividends. How many young startup companies pay dividends? But by, in fact, reducing the taxation on capital gains, which is the way that young growth companies reward their investors. I'm biased, of course, since that's what we try to generate. But the capital gains tax before that change was actually higher than ordinary income taxes. In 1978, it got rolled back. And what happened? The venture industry went from $100 million a year to about $4 billion a year. That's 40-fold growth. It was incredible. It seems small now, but it's amazing how fast it grew. And there was more money that wanted to invest, so the world created these things called buyout firms, because before that, we'd do a startup one day, and then next deal might be a later stage deal called a buyout, and that's what the very, very early venture capital firms did. But turns out buyout firms could consume more money than venture capital firms because they can do great big deals. And startups, it's hard to put $1 billion into a startup, but it's not that hard to find $1 billion company to buy and recapitalize and sell. Some people have tried to put too much money into startups, and they got into trouble when they did that. So the industry kept growing, and by the mid-90s, the venture and the buyout business had grown to almost 20 billion. Now we got to change scale, because guess what? By 2000, I'm sure many of you, I look around, remember the bursting of the dot-com bubble. That was 2000. The venture capital industry tried to invest almost $100 billion that year. That was a lot of bad investments were made, I'm sorry to say. And the buyout industry also put out almost, I get the right place over here, another 100 billion. And then we had the bubble burst and we went through the downturn. And today, 10 years later, venture capital is still not anywhere near that 100 billion level. In fact, last year, the venture capital industry raised about 10 billion and invested about 20 billion. It had some money that's still left over from better fundraising years. But look what's happened to buyouts. They went crazy. And the last bust that we had, of course, was more of a, as we all know, a leverage-driven, buyout-driven bust. And now the whole world is back to more sanity. I get asked often, is there too much venture capital? Is there too little venture capital? From the perspective of an entrepreneur, there's always too little venture capital, right? But what's the right amount of venture capital? I think it's probably kind of where we are today. That's an easy thing to say. But there's only one common denominator that I can find all the way through this period of time, all the way back in the mid-'80s, when the venture capital industry was investing a few $1 billion a year across the country. It was financing about 1,000 new companies a year. 1,000 companies, $4 million a company on average, $4 billion. That's about what was happening back then. Today, believe it or not, our industry still finances about 1,000 companies a year. They each take about $20 million on average, so we invest about $20 billion. We tried to finance too many companies in 2000. Actually, 3,000 new companies were funded by venture capitalists. That may sound nice to you entrepreneurs, but guess what happened? Wherever there was an opportunity, we funded 4 companies to shoot at each other and kill each other. It was very tough. We funded a company called mothernature.com. Some of you may have actually seen the great big sign as you went into the airport at the Boston Logan Airport. And we gave it a lot of money. We and some other venture capitalists, $50 million, because they were going to have to advertise on television. Back then, the internet businesses were B2B, and you had to advertise to get to the consumer. Well, 5 other companies got $40, $50, $60 billion too, and they all killed each other. And that happened in B2B business, company after company. It was a very difficult time. So the venture capital industry today is going to finance about 1,000 companies. Most of you will not raise venture capital. You're probably too smart to deal with pushy venture capitalists like me. But in fact, that 1,000 companies are the ones that need tens of billions of dollars. This country starts through entrepreneurs like many of you, over 500,000 new businesses a year. I think the number's more like 700,000. Not bad, since I think our birth rate is about 2 or 3 million a year. We create a lot of companies. A lot of them don't survive. People create new ones. But let's make the math simple. 500,000 companies are formed. Venture capitalists finance 1,000 of them. There's another 499,000 companies that we don't finance, and they don't all die. Some of them become really successful. Now there's this group in between called angels. I mentioned them a minute ago. Angels finance maybe 50,000 companies a year. So 1,000, 50,000, and then about 450,000 to 500,000 that are financed by family and friends and savings, and that's the way most companies get going. So I've got too many things in my hand here. The other piece of the question in terms of how much venture capital is too much and how much is not enough, I like to think of our business like a business. And if you think of our product as a young growth company, we sell it into the stock markets. Now, this is not the way you normally see NASDAQ or Dow Jones. This is the total capitalization of the stock market. So in fact, Dow Jones, NASDAQ are smaller. The S&P 500 has a total market value today of $10 trillion, give or take a trillion or two. You know, this, some politician once said, you know, $1 billion here, $1 billion there. Anyway, there's a $10 trillion market. If we, as an industry, invest 20 million, if angels invest another 10 million, if individuals, let's say 50, that should be billions, pardon me, 50 billion gets invested in these companies, and we're all good and we double our money, we create $100 billion of market value every year. There's plenty of room in this market to absorb that. A $10 trillion market that's going to grow 10% per year can easily absorb what we venture capitalists are creating if we create some good companies. And that can absorb what you guys are going to build if you build some good companies. It can't absorb the kinds of numbers we were talking about in 2000. And so my point again is we're probably about where we ought to be. And so, where does this money go? As you can see, 10 years ago, information technology was the majority. In fact, for the first 30 years of my experience in venture capital, information technology is where most of the money got invested. And that ranged from semiconductors to software and a lot of software companies. That's changed over the last decade, and not just because of that little piece at the top called energy. It's changed because healthcare is getting a bigger slice of the money right now. And it's also changed maybe in part because of terminology. Consumer services are growing. I think that's basically internet. That's a consumer-facing internet businesses. And that's what we're seeing a lot of these days. And I think even some of the business and financial service companies are what we would call IT or software companies. So maybe order of magnitude, it hasn't changed too much. If we're going to invest $20 billion a year as a venture capital industry, there are about 1,000 venture capital firms. Half of that might go into the world of IT, and a significant chunk of that's going to go into software.